Hi, good afternoon, everyone. I'm Daphne from the Institute of IBF, and we are delighted that you are able to join us this afternoon for this IBF Masterclass, jointly organized with WMI on crypto, digital assets, opportunity, risk, and regulation. We are glad to have with us today Onai Singh, Executive Director of Deloitte, and Sharon Craig's Director Program Development from WMI. Before I get them to share their insights, for those who may not be familiar with IBF, please allow me to do a very brief introduction on IBF and the resources we have to help professionals in the financial industry. So the IBF was established by the MAS in 1974 as a training provider to provide functional training for the financial industry. Since then, our role has evolved into one of the standard settings for financial services sector skills and competency. In August 2018, our mandate was expanded to cover career advisory and job matching function for the financial services sector. We are also appointed as the Jobs Development Partner for the financial services sector by the Jobs Development Council and now oversees both skills and jobs development of the financial industry in Singapore. Here's a quick look at our services and how we support the industry across training, recruitment, and workforce transformation. You can find out more about our services and connect with us at any of these areas via our website. So the enhanced course fee subsidies, which are part of MAS support package to encourage companies to send their employees for training and upskilling, will continue to be updated. So do check back with us, on the updated subsidies. So here's the overview of the subsidies that we have. So training course subsidies under IBF STS program will be at 70% for trainees below 40, while remaining at 90% for trainees above 40 years old. And training cost subsidies for IBF FTS programs will be at 50% for trainees below 40 years old, while remaining at 90% for trainees above 40 years old. You can find out more details of the IBF subsidies on our website. You can also find the list of eligible training programs on the IBF Program Finder on our website. In addition, the IBF will also be supplementary commercial training available with free webinars during this period, like the one that you're attending right now, to support the training needs of the industry. Financial professionals can also tap on the Learn at IBF mobile learning app for bite-sized learning at your own leisure. All this complimentary training are accorded with CPD hours. So now that concludes my very short introduction. I shall now hand the time over to Sharon to take us over. Over to you, Sharon.
Thanks very much, Daphne. A warm welcome to everybody on the line here today. Let me just say a few words about the Wealth Management Institute for those of you who aren't familiar with us, and then to introduce the subject and to introduce Naising. So you can see here today we've got IBF, WMI, and Deloitte in true partnership to deliver upskilling, training, and these are absolutely courtesy of the nation state for your value and benefit. WMI was established by Temasek and GIC about more than 20 years ago as a center of excellence for education and training in wealth management and asset management and the related financial services disciplines. So robust risk management is core to this. We just give you some numbers. 18,000 enrollments annually across more than 100 accredited IBF programs. So very much supporting the pillars that IBF had communicated to you earlier. And we work with participants from more than 150 financial institutions across Asia. And our faculty is also regional, global, from the industry and of the industry on all the disciplines that you see below. So for today's subject, it's digital assets or crypto assets, the opportunities and landscape, which we'll go through, the risks and the regulation, and where do we go from here? So you know that this is an asset class that has made many people wealthy, is extremely volatile, and has also seen some fortunes lost. It's an asset class which facilitates financial inclusion with mobile technology today. and still has possibilities based on technology and blockchain and use cases that we are still exploring. But when you learn to ride a bicycle, as it says, as you have digital innovation, you also got to learn when to swerve and when to put on the brakes. So I'm very pleased to welcome Naising today to take us through this subject. Naising is currently Executive Director, Risk Advisory at Deloitte & Touche Enterprise Risk Services. He heads the Regulatory Risk Services line in Southeast Asia with more than 20 years experience in regulatory policy, financial stability surveillance and supervision across all the classes: banking, capital markets, payment systems, technology risk. Naising's a very modest man. He was previously with MAS as a very senior supervisor and was part of the innovation in the payments services area, and therefore encouraging innovation twinned with prudent risk management. So with this, let me hand over to Naising.
Thank you very much, Sharon, WMI and IBF for inviting me to this session. I wouldn't dare to claim that I'm conducting a masterclass in digital asset, given how rapidly this market is developing. Rather, I'm grateful for this opportunity to just share some personal perspectives. And I would really like to hear from you, the participants, on the challenges that you face, and also on your thoughts on how the market will evolve, because only through that exchange, I think we can all learn together. Before I start, the standard disclaimer: the views that I express in this presentation are my own, and they do not represent those of Deloitte or any other organization that I've worked with. So let's get to the first page. So let's start with what we are seeing in the market. So you can see here on this slide that the digital asset market has seen explosive growth and high volatility in the past few years. You see that market capitalization of cryptocurrencies rose from almost nothing 10 years ago to more than $3 trillion before crashing back down to about $1 trillion recently. The number of cryptocurrencies also mushroomed from around 2,000 in 2019 to more than 19,000 now. Right? Trading activity has grown to around 150 to $200 billion a day. And recall earlier we talked about the total market capitalization being about $1 trillion. So this means that the daily turnover rate is around 15 to 20%. Right? Compare this with the NYSE, the New York Stock Exchange, which reported a monthly turnover ratio of around 12% in June. Okay, so in New York Stock Exchange, it's a monthly turnover ratio, 12%. The daily turnover ratio for crypto assets is 15 to 20%. So that's a really quite a different order of magnitude, right? So I'm sure no one would argue with the assumption that NYSE listings are underpinned by more real economy activity than digital asset listings. So it looks like there's really quite a fair bit of speculative trading in digital assets. Another observation also on this chart is the high level of interest in digital assets in Southeast Asia. According to a World Economic Forum survey, Vietnam and the Philippines are the second and third highest cryptocurrency usage rates in the world. Right? So looking across the world, these two countries have the highest, the second and the third highest cryptocurrency usage rates in the world. In Singapore, Bloomberg reports that almost half of the fintech funding raised here last year were for crypto and blockchain ventures. So really, there's a lot of interest in digital assets in this part of the world as well. So maybe at this point, I would like to take a pulse check on your level of interest in digital asset investments. If you can go to this poll, pollev.com, 91365, you'll see the poll question, right? So have you invested in digital assets? Yes or no? Maybe I'll give everyone a moment to go onto the poll and respond. Wow. wow, almost 3/4 of you have invested in digital assets. That's a relatively high percentage. Recently, I did a seminar also for the Singapore Computer Society. I would imagine that, they being specialists in computer science and computer engineering, there will be a higher level of investments in digital assets, but it turned out that it was roughly equal, right? 50-50, yes or no. So this group is really quite skewed towards people who have an interest in digital asset investments. So now to the next question, which is the million-dollar question, and sort of Sharon hinted at it earlier, right? So how has your investment in digital assets performed? Are you making a profit, breaking even, sitting on losses, or you prefer not to think about it and therefore you're unsure? Wow. Quite a number of you are looking at losses. Possibly you went in last year during the run-up. So potentially that's the reason for the losses. Okay, I shouldn't dwell on sad stories. Actually, when you think about these questions, they are a bit of a trick question, right? Because I've not really defined what I meant by digital assets. So were you thinking of like cryptocurrencies when you answer the question? Is it like Bitcoin or Ether that you invested in, or other types of cryptocurrencies in the market? Or do you invest in some of the initial coin offers during the ICO boom in 2017? Or have you bought sort of non-fungible tokens, right? And so maybe hopefully with this next few slides, we answer that question of what is a digital asset. So I would suggest that it refers to digital representation of ownership of anything of value. Okay. So it's a digital representation of ownership rights in anything of value. And you may argue, right, that there are already many pre-existing digital assets. So for instance, SGX went scriptless many years ago. So when we trade shares on the Singapore Exchange, we don't transfer physical share certificates, right? The transactions are merely recorded as entries in our CDP accounts. And also many of us don't hold much cash with us these days, since we can always pay using our e-wallets, using PayNow, and then for larger payments, we can use FAST or Gyro. And these transactions will be recorded as transfers of bank balances from one bank account to another bank account. So our CDP and bank account statements then become digital records of our asset holdings, right? But what distinguishes the current wave of digital assets is really the use of tokenization. So this involves the use of software programs to convert ownership rights into digital tokens. And instead of transferring bank balances or holdings of scriptless shares from one account to another, we are now transferring digital tokens from one person to another when we talk about digital assets. And these transactions are often recorded on a distributed ledger, right, which provides an immutable record of all the transactions that have taken place on that protocol and who owns what in that ecosystem. Right? And lots of things can be tokenized. So I give some examples here. Includes traditional securities like shares and bonds. You could have real estate investments. You could have paintings. You could have music, maybe a song, and also the copyright of that song, right? And various other assets as well. So the important thing to know is that the rights and obligations of the holder of that token is programmed into the token, right, based on the protocol on that ecosystem. So for example, if I bought a digital token of a song, then I will be able to listen to that song just like I would be able to stream a track that I bought on iTunes. But if I bought a digital token of the copyright of that song, then I can earn royalties whenever anyone buys or streams that song, right, myself included. So that's the difference, right? And it really depends on what is programmed into that digital token, right? Whether I own the copyright or I only have the right to listen to that platform. So if you move to the next slide, it's probably evident to you now, right, that there are many different types of digital assets. And one way to classify them is really by looking at their underlying economic substance. So there are payment tokens, which are digital assets that can be used as a payment instrument to facilitate transactions. Notice I said can be used, right? Because I suspect until now, most of the payment token transactions that are conducted in the market are for speculative, right? Speculative purposes rather than to make payments. The volatility in the prices of many of these payment tokens make them unsuitable as a medium of exchange, a store of value, or unit of account, right? So they are more like investment speculative products than payment products. Then there are, of course, different variants of payment tokens, just like there are different COVID-19 variants. So you'll be familiar with privately issued cryptocurrencies like Bitcoin and Ether. Then there's a subvariant of these privately issued cryptocurrencies called stable coins. And these stable coins aim to address the issue of price volatility by pegging the value of the payment token to a fiat currency, a commodity, a financial instrument, or a pool of assets, right? And then there are also central bank digital currencies, which is really a digital form of a country's fiat currency issued by the central bank. Then if you turn to the right-hand side, there are security tokens, right, that aim to replicate traditional securities like shares and bonds. They represent ownership interests or claims on the cash flows of a company. There are also non-fungible tokens. So these are unique tokens that represent assets like artwork, real estate, and so forth. An example would be car NFT. So these are like beautiful pictures or videos of cars. When you buy them, you just get that picture or that video with the audio, but you don't actually own the car. Okay. Then finally, there are the utility tokens, which are like digital assets used for specific purposes within a network, right? Such as the in-game tokens that you can buy in various video games. Or another example is Filecoin, which can be used to pay for online storage operated by Filecoin. So these different digital assets can pose various risks to the financial system. First, due to its decentralized nature and also the use of pseudonyms and wallet addresses instead of real names, cryptocurrencies can be exploited for money laundering and terrorist financing purposes. Also, there are inconsistent AML/CFT regulations in terms of the activities and the intermediaries that should be regulated when they are conducting digital asset activities. So this also presents a challenge in terms of having a consistent approach for addressing AML/CFT risks associated with such activities. The second risk is around technology and cyber risk. There have been multiple hacking incidents involving crypto exchanges and crypto wallets over the years, and millions of crypto dollars, right, have been lost. And this challenge is made greater because the technology is rapidly changing. And I think for many of the operators, there's often a push for speed to market without proper consideration for the security and resilience of the system. So that's why they become more prone to hacking incidents, or they may just break down because they are not able to deal with the kind of volumes that are taking place on their markets. The decentralized nature of many DLT networks also makes it very difficult to safeguard cybersecurity, because the network is only as secure as its weakest link. There are many participants, and it's very difficult to ensure that every single participant keeps up with the sort of right standards of cybersecurity and resilience. Then turning to the area of consumer protection, there has been concern about highly volatile and the speculative nature of many existing digital assets, and how these products may not be suitable for retail investors because they simply cannot stomach the kind of fluctuations and potential losses that may arise. And the recent failures of some crypto firms have also highlighted that investors may not be fully aware right, of the nature of the investments and their legal rights, right? Whether they are entitled to immediate redemption and so forth. A further consumer protection concern is with market integrity. So here the risk is around market manipulation and insider trading. As trading in digital assets remain outside of the regulatory ambit in most markets, the risk of market abuse, right, such as cornering, front running, pump and dump operations cannot be discounted. And this can happen particularly in some of the less liquid crypto assets, where it's possible for certain players to come in and corner the market and manipulate sort of activity in the market and take advantage of other investors. I think also on the slide, we highlight financial stability, because I think regulators are beginning to pay closer attention to the financial stability risks that are posed by digital assets. I think the general assessment remains that the digital asset market remains relatively small as compared with the overall financial system. So this risk of the financial stability risk is still at this stage within manageable limits, right? But there's a risk that it can grow rapidly. First, because banks and other traditional financial institutions have started to think actively about including digital assets in their product portfolios in response to customer demands. In my work, I've sort of had conversations with different clients who have asked about, what does it take, right, to introduce such products in Singapore and other markets, and what should they be aware of, and how should they do so in a very controlled, right, and responsible manner. So certainly, I think traditional financial institutions are thinking of how to incorporate digital assets into their service offerings. I think consumers too are looking at alternatives, right, including the use of stable coins if credible backing mechanisms can be put in place. So they are also looking at how they can participate in this market in a safe manner. So should digital assets gain traction more broadly, their systemic footprint will of course increase, right? And then regulators will need to consider appropriate measures to address that systemic risk. And finally, there are concerns in some quarters about the potential environmental impact of digital assets due to the high energy consumption associated with validating transactions, mining crypto assets, and so forth. So in China, for instance, they have banned Bitcoin mining, right, citing such concerns. It is hoped that technological improvements, such as using proof of stake rather than proof of work, will help reduce the environmental impact of digital asset markets. So notwithstanding all these risks, I think you could see that many regulators around the world are taking active steps to explore how to develop digital asset markets in a sustainable manner. And this is because digital asset ecosystems can bring many potential benefits, right? Because of its decentralized nature, distributed ledger technology can facilitate direct transactions between market participants without having to go through intermediaries. So this can improve market efficiency and lower costs. The immutable records in the distributed ledger, right, can serve as a golden source of truth, thus avoiding the need to conduct duplicative checks. Right? So besides contributing to greater efficiency, it also addresses regulators' concerns about AML/CFT risks. Right? It provides adequate, of course, provided that adequate controls are put in place to ascertain the identities of market participants and monitor their behaviors. I think DLT also provides the opportunity to embed finance seamlessly into day-to-day activities through the use of smart contracts. So for instance, travel insurance can pay out immediately when there's a flight delay without having the insured to actually file an insurance claim. That saves a lot of time and of course improves the user experience and contributes to economic efficiency. And finally, digital assets can contribute to financial inclusion because investments can now be fractionalized, right? Broken down into smaller, more affordable quantums to meet investors' needs. In a way, this is like securitization, but it's on digital steroids, right? So it's, securitization helps to pool together assets that are not normally available to the retail market and breaks them down into bite-sized chunks that can be bought by retail investors. Similarly here, digital assets can potentially help create a fractionalized market for certain investment products. So we have seen many experiments and use cases. And in Singapore, you will be familiar with Project Ubin. So it's a series of sandboxes involving MES, technology providers, financial institutions, and other central banks. And these experiments have allowed the participants to test the technology, iron out issues, and in some cases even launch commercial use cases. Right? So for example, in the case of cross-border payments, Patio, so this is a joint venture between DBS, JP Morgan, and Temasek, has set up a wholesale settlement network using DLT, which helps to reduce settlement time from days to minutes. Still on cross-border payments, MES is working with other central banks as well as with the BIS Innovation Hub on Project Danba. So this is a project to design a multi-CBDC platform to facilitate cross-border wholesale CBDC transactions. In trade finance, Contour, a global consortium of trade banks as well as corporates, are using common ledgers to automate document verification so as to speed up the financing decisions and also to lower processing costs. And in the capital markets, SGX and Temasek are collaborating on market node to tokenize assets and reduce the time needed to clear and settle securities transactions. So there are really multiple use cases, examples of actual use cases that have been launched in the market, and hence that interest to try to facilitate the adoption of this technology. So how is MES balancing this mix of risks and benefits, right, in the Singapore market? So as shared by MD Ravi Menon on Monday when he talked about the digital asset market, MES wants to promote an innovative but responsible digital asset ecosystem in Singapore, right, to enhance efficiency and to create economic value. So my sense is that MES has adopted a risk-focused approach, one that aims to facilitate that technology adoption while controlling for key risks. And MES does this by looking at the economic substance of digital assets in question to determine if it should be regulated as a payment token or a security token, right? So for payment tokens, the focus has been on money laundering risk since MES first approached regulating cryptocurrencies in 2014. The concern was that criminals and terrorists could exploit the pseudo-anonymity offered by crypto assets to transmit illicit funds. So the Payment Services Act subject all digital payment token intermediaries to stringent AML-CFT requirements to prevent such abuse. And earlier this year, the law was amended to apply the AML-CFT rules to digital payment firms incorporated in Singapore, even if they are serving only foreign customers. So they are not actually conducting regulated activity because they're not targeting Singapore customers, but they will still be caught by this change in the law, right? So this is in line with the FATF guidance and helps to close off opportunities for regulatory arbitrage by setting up shop where you're not actually serving the customers. Digital payment token operators are also subject to technology and cyber risk regulations. This follows from the experience with Mt. Gox in Japan and other hacking incidents involving crypto exchanges and crypto wallets that I mentioned earlier. MAS has also been issuing consumer advisories that crypto assets are not suitable for retail investment given the high volatility since 2017. And earlier this year, MAS took further steps to discourage retail participation in the market by restricting the marketing and provision of crypto assets services in public settings in Singapore. On the other hand, if you look at security tokens, MES will regulate them in the same way as traditional securities if the digital token is recognized as a capital market product under the Securities and Futures Act. Right, so this means that offers of such digital assets will require a prospectus unless exempted. Intermediaries providing services relating to such products will also need to be licensed. And the type of regulated activities that are caught include dealing in capital market products, custodial services, market operating, so operating an exchange, or providing financial advice. So these are currently, right, the approach that MAS has taken to regulating payment tokens and security tokens. But if you look further beyond the current requirements, there's a lot of developments taking place, right, internationally, in terms of how regulators are thinking about the risks posed by crypto assets and what are the appropriate regulations that need to be put in place. So in the US earlier this year, a bipartisan bill was tabled in Congress to create a regulatory framework for crypto markets under the Commodity Futures Trading Commission. Right? Traditionally, this agency has been focused very much on disclosures and ensuring fair disclosures to investors, as well as monitoring market behavior for potential market manipulation, market abuse. Right? So very likely that will be a focus area, right, if this law gets passed. In the UK, they have also introduced similar requirements as Singapore in terms of advertising regulations, requiring cryptocurrencies to be subject to the same advertising regulations as marketing of other financial products under the FCA, the Financial Conduct Authority. In Spain, the market regulator there also monitors advertisements for crypto assets. And in fact, they go into looking at social media posts. And earlier this year, I actually criticized a football player, Andre Iniesta, for promoting certain crypto assets in his blog posts. MES also indicated this Monday that they're planning to consult in October on further consumer protection measures. These include customer suitability tests, restricting the use of leverage, and also enhancing disclosures and deterring market manipulation. So really quite a number of areas that the regulators are looking at in terms of consumer protection. Then turning to financial stability, let's look at the international standard setters and what they are doing. So the Basel Committee has published a consultation paper on the prudential treatment of banks' crypto asset exposures. So the concern here is that if banks get exposed to crypto assets and they should come under stress, then potentially a key part of the financial system, right, the banking system may be under threat. And so the hope is that through proper regulation, we are able then to monitor and control for the risks that banks are taking on when they participate in the crypto asset market. And so there are different categorizations of crypto assets, depending on the extent to which they sort of mirror or are able to replicate the characteristics of traditional assets. So the group 1 assets are those that are pure representation or tokenization of traditional assets. Then you have a group 1B, which refers to stable coins with good, solid, credible asset backing. And then a group 2 of other crypto assets that will be subject to the most stringent requirements. Separately, the Committee on Payments and Market Infrastructure, CPMI, together with ISCO, the International Organization of Securities Commission, also issued guidance that require systemic operators of crypto asset markets to comply with the same requirements around technology risk, credit risk, settlement risk, and so forth that are imposed on traditional payment, clearing, and settlement systems. This is to ensure that these market operators, right, remain resilient throughout different market cycles and so forth, ensuring that they are able to serve the market on an ongoing basis. So these are really the focus areas for the international standard setters, right? How to make sure that exposures to crypto assets are well managed by large systemic financial institutions like banks, and then from the CPMI and ISO focusing on the market operators for these digital asset markets, making sure that they are resilient, that they have good risk management controls in place. Turning to the individual countries, in the UK, we saw a sort of discussion paper that was published, and then following that, a consultation response earlier this year on a regime to manage the failure of a systemic digital asset firm. Right? So they are very concerned about how, if crypto asset markets become more well accepted by investors and by other financial institutions, that they could become systemically important. And if such a systemically important crypto asset firm should fail, how should that be managed in a orderly fashion within the UK market? In Australia, the Australia Treasury had issued a consultation paper to propose a regime, right, to license all secondary service providers for digital assets, right? And this is not limited to only digital assets that sort of replicate or are akin to financial products. It is any digital assets at all. So even your car NFTs, etc., may be regulated under this regime. And we do see such regimes in other countries as well, in Switzerland and also in the Bahamas, where they have digital asset regulations, right, for products that are in the digital world, as opposed to sort of real economy, real world financial products that are regulated by your traditional financial regulations. And MAS also is in discussion with international standard setters on various sort of financial stability controls in place. So they're looking at whether there needs to be certain minimum standards in terms of reserve backing for stable coins, timely redemptions for stable coins as well. So these are various standards that are being thought about currently. So to sum up, I think the risk-focused approach is probably sort of a right approach, right, to facilitate that innovation while adapting the regulation to the risk environment. The challenge is that in a rapidly developing industry, the risk landscape could shift very, very quickly, right? And then for the regulator, when you are adjusting the regulations, it creates a tension, because the other reason why regulation is important is to provide certainty to the market, to provide a confidence to market players that there's a stable environment and we can plan our business and plan our approach to growing our business in a sort of stable manner. But if the regulations are changed, then that may well affect the ability to continue the operations or continue the business plan as earlier provided for. So that's a sort of tension that needs to be managed. But I think that then market participants can play a key role, right, in helping to monitor the risk environment, working with the regulators to see how that risks that are sort of emerging can be mitigated. And one particular risk that I want to highlight is really this sort of the blurring lines between regulated and unregulated activities. And particularly, I think sort of going back to what we saw in Australia, the consultation, and also in Switzerland and the Bahamas, whether a case can be made, right, to move away from trying to look through to identify what's the economic substance of different products, to actually having a regime in place that regulates digital assets per se. Because if you think beyond sort of the immediate term, if the metaverse takes off and more products get on to the metaverse, become, there will be proliferation of digital assets. And how do you then manage and regulate such an environment to ensure that you have a stable environment for the growth of this market? So that would be my sort of parting point on this point. Yeah. So with that, maybe I'll hand back the time to Sharon and we can move into question and answers.
Thanks very much, Naising. There is one question in the chat which you may have covered in your presentation, but I think it's worth going through for Ryan. For security tokens, are there regulations governing such token class? Yeah. You want to take?
Sure. Yeah. Thanks very much, Sharon. Yeah. So that indeed, there are regulations for security tokens, but they are not called out separately from your normal regulations that apply to any capital markets products or the provision of financial advice. What MAS has done is issue a set of guidelines on digital token offerings to explain how the law as currently crafted would apply to such security tokens. So as I mentioned earlier, if a digital token is basically lives and breathes like a capital market product, then you will be treated as such, and you will be subjected to the Securities and Futures Act or the Financial Advisors Act accordingly. So if you are offering a security token that is a capital market product, then that will require prospectus unless there are certain exemptions that you can make use of, like a small offer exemption or a private placement exemption. And if you are an intermediary dealing in such products, then you need to have a capital market services license. And if you are providing advice on such products, then you would need also a financial advisor's license. So the way that MES has tried to apply the law is looking through to the economic substance of the transaction and then applying the law as it's currently written. I guess the challenge that I sort of pose at the end there is that while this makes sense, right, because you want to ensure consistent and even-handed treatment of digital versus non-digital or traditional product classes, sometimes it becomes difficult to really draw the line where a product morphs into a financial product, or even between different financial products, maybe they have different features that straddles different laws, and then what would be an applicable or appropriate regulation to apply in such circumstances.
Thanks so much for that. Ryan, I hope you've got the sort of top level response to your question. Behind that is, how do you tell it's a security token versus some other tokens? And then I'll maybe ask Naising to address some of the other questions before going to your deeper level question, Ryan, which is where to find guidelines for security tokens, particularly for startups. Maybe come and hang out with us a bit more, Ryan, after this. But before we get to that, maybe Naising, we can take Louise's question. He's asked about, you covered proof of work and proof of stake in your presentation. Can you explain or elaborate the difference between these two?
Yeah, I'm not technically strong in this area, but if I were to simplify it, right? So what I understand is that, say for instance, for the Bitcoin protocol, in order to validate a transaction, there's basically a set of mathematical problems, right, that needs to be solved. And what many participants in the market do then is to invest in the technology to solve this problem as quickly as possible, so that they will be the one contributing to the validation of transactions and then will receive the reward for doing that validation. As the protocol becomes more and more evolved, the types of problems become more and more challenging, which therefore requires more and more computing power and hence the energy consumption. In the case of proof of stake, it is more controlled in the sense that the validation of that transaction is left to people who have larger stakes, right? So as long as you have more significant stakes, you have a larger say in validating a transaction, and that hopefully reduces the amount of computing power that's required in terms of validating transactions. So it's a very simplistic explanation. I'm sure that there are many others on the call who can explain this much better than I. So I will defer to others who have that more professional and technical knowledge of these two different protocols.
So proof of work started first, and then proof of stake is sort of an improvement on it in terms of validation. Luis, I hope that covers it for you, yeah? Rolf has a question. What would you consider to be meaningful listing rules for tokens on crypto exchanges? How should they distinguish between the different types of tokens? So Rolf is asking the question on the different tokens out there. And if they were to be listed, what would be the meaningful listing rules?
Yeah, this is a very excellent question because if you think about listing on a stock exchange, a company that wants to list on a stock exchange has to prove that it has a business case, right? Prove that it actually has some activity that contributes economic value and is either already making profits or is valued by investors because they see that there's potential for profits, right? And then, if the company complies with those rules, it can get listed. This doesn't apply in the case of crypto assets. So as long as someone comes around with a white paper with a protocol, they can sort of get themselves listed on the sort of crypto exchange. And I guess the challenge really is that because this is seen as a sort of unregulated and speculative market, there's no minimum standards to require the crypto issuers to comply with. So I think there might be some standards around technology and so forth, but other than that, I think very minimal requirements or expectations. And when you think about the sort of what these crypto assets are, they are basically the lubricant, right, to facilitate the use of that protocol. So whether this lubricant will be valuable will depend on whether the protocol is actually in demand and used by the market. So there must be real business case in order to justify why a particular crypto asset should enjoy a higher valuation than another crypto asset. But I think a lot of that sort of has been disregarded, or investors have sort of thrown that caution to the wind, right, and just invested in these products just for speculative purposes.
Thanks, Rolf and Haising. I think that actually covers the value of the underlying and the importance of educating oneself on this. There are some other questions, and let's address the exchange between Amy and Kenneth first. So there's an exchange of questions on digital asset custodian licenses. Amy has asked, is there clarity in terms of digital asset custodian licenses by MAS? Some of these digital asset custodians hold a CMS license, some hold a payments license. So is there some underlying rationale for this? And then Kenneth is adding to this by asking governance issues surrounding regulations and custodians, and should there be a multi-tier market to address this type of situation? So I guess Naising question, payment license, CMS license, how should a digital asset custodian be licensed?
Yeah, maybe I'll take Amy's question first, and that goes to the point about how MAS looks at this market, that they sort of distinguishes, MAS distinguishes between a payment token versus a security token. So if a token is regarded as a payment token, then sort of custody of that payment token, wallet, etc., now will be caught by the Payment Services Act with the latest change in the rules that requires sort of wallet operators to also be subject to licensing and the AML/CFT rules. But if that product has the features of a capital market product, then it will be treated as custodial services under the Securities and Futures Act, and the operator will need to then hold a CMSL license for custodial services. So it all boils down to the nature of the product, which I guess your sort of underlying your question is not always so clear, right? How you actually identify whether a product is a payment token or a security token, especially in the current situation where the so-called payment tokens are held not for payment purposes. They are bought and sold for speculative purposes, almost like any investment product that is available in the market.
Thank you.
Yeah, so that's to Amy's question. To Kenneth's question, I'm not sure what you meant by a multi-tier market.
Do you want to elaborate, Kenneth? Just ask your question. Maybe elaborate on this. Feel free to speak up, Kenneth. Otherwise, or type your answer in. Okay. Otherwise,
Sorry, can you hear me?
Yeah,
Yes.
good to go.
Yeah, sorry. Okay, my point is that in many jurisdictions, we have seen a different risk profiling for different investors. And I guess in the case of crypto, while we are trying not to meddle with the merits of cryptocurrency, which is decentralization, at the same time, there will be, there's a need to sort of sieve out or to filter out which are the risky platform and which are the risky type of crypto investment. My point is that eventually would all the regulators and all the central banks come together and say that maybe we should segment the different risk profile of the cryptocurrency into, say, for instance, category 1, category 2, and so on. Not saying that this is the best solution, but I see that as a fundamental way to address the diverse product offering out there.
Yeah, thanks very much for the elaboration, Kenneth. Indeed, I think that is happening. So when I mentioned the Basel Committee, that's the approach that they're taking. So they're looking at sort of at the tier 1 products that replicate existing sort of underlying financial products. So it's merely tokenizing an existing share or existing bond, right? So there's no other sort of innovation other than just making it fractional. Then as a sort of slight modification, you have stable coins. So stable coins are not real legal tender money, but they are sort of referencing some pool of reliable, high liquidity assets that can be liquidated to fulfill any obligations, in redemptions and so forth. So that's your tier 1B. And then of course there are the other crypto assets that are sort of considered as not so safe because they are not replicating existing traditional assets, or they are not backed by traditional assets, right? They're just out there, and there's a lot of speculation taking place. So they are then subject to the highest, most stringent requirements. So one way is to tier the products. Another way is to tier the investors, which in some sense MAS is already doing by saying that, hey, there should not be active marketing of crypto assets to retail investors, right? So they already distinguish between accredited and institutional, where you can continue to sell, but for retail, you cannot do that active promotion to the retail market. I think with some of the possible changes that MAS has hinted at, in terms of like doing knowledge assessments, limiting the amount of leverage and so forth, some of these differentiated measures may also be targeting more of the retail market versus the accredited and institutional market. So there will be tiering also of the investors. So both from the demand side as well as the supply side, I see that there will be some level of tiering of the market.
Thanks very much, Naising. In the interest of time, I think we can just take a couple of other questions. Maybe I'll take them together. There's a question on how much trade finance document tokenization is in the market. There's a question on where digital assets are used as collateral for loans. What are the key risks? And on that risk point, Saurabh's asking, are stable coins truly stable? So maybe Naising, if you just take all three and we'll just,
Sure, On trade finance, I mentioned Contour, but I think there were also a number of other platforms or consortium that sort of worked on a similar concept. A number of them have sort of stopped operating or at least gone dormant. So I think we are still in early stages of doing this, and really it requires collaboration of multiple parties in this ecosystem. Right? It's not just the banks themselves. You require also the corporates, the large trading houses, etc., to also participate to make this a fruitful exercise, and sort of agreeing on common protocols, common data formats, and so forth. All those are not simple issues to address. So I think certainly we are still in early stages of doing that. In terms of taking digital assets as collateral, I mentioned earlier in my presentation that one of the key concerns around digital assets is that there's lack of clarity around the nature and the terms of these assets, and sometimes the legal enforceability of the terms also. Which country's law will be applicable and so forth. So I think these would be key considerations when thinking about accepting digital assets as collateral. Then not forgetting, of course, there's also all the cyber and technology resilience risk that comes into play, because all these assets are recorded only in digital format. So, how do you make sure that you actually are able to take or enforce on these collateral when the time comes to do so? So I think that will be another consideration. And then to the question on stable coins, whether they are truly stable, is really a misnomer. I think many issuers may call their product a stable coin, but they are hardly stable, right? Because there is currently no standard at all on what are the types of mechanisms needed to stabilize the coin, right? What would be acceptable assets to count as backing for a stable coin? What kind of fluctuations would you allow? When do you need the issuer to top up, right, the assets if there are any changes in pricing of the underlying assets? How quickly do you expect the issuer to pay or redeem any request for redemption? So all these will be issues that will need to be addressed in order to come up with real stable coins, right, that meet sort of global standard of acceptable stability. Yeah, because otherwise people are just buying into a promise, and then when bad things happen, they realize that the promise is popaki, right, and they will lose their money.
Thank you, Naising. We come to the conclusion of today's session. Just a few words. Firstly, a big thank you to Naising, who's traversed the universe, regulations around the world, as well as actually showing us some of our nearest neighbors are globally the top 3 in cryptocurrency penetration. There are many more questions than these. I'm glad to see actually everyone can participate. There's a very high participation penetration in this session. And B, everyone has a role to play in your own risk management. Let me just, please do come and join us if you'd like to know more about this asset class and what we do. Please, Ben. just on one page, we want to share with you in terms of the IBF accreditation that you can take to be more conversant in this area. We have a number of advanced level programs. You can see them on the left-hand side, and they're in risk management. We have a number of foundation programs. They are on the right-hand side of what you see here. And specifically in compliance analytics, RegTech, and in digital assets, legal, regulatory, risk management. These are upcoming. So we'd love to welcome, there are about 250 people joining us today. We'd love to welcome some of you. With this, a big thank you to IBF, to Naising. We would like to have a community of learners together, co-creating actually both the asset class and its risk management. So if you wouldn't mind scanning this QR code, there are just 3 questions we ask you for your feedback, how you found this session and what you'd like to see more of in terms of masterclasses. And if you want to know more, just leave us your contact as well. And we'd like to continue to be in touch with you. Yeah. Thank you, everybody. And thanks, Naising and Daphne.
Thank you,
Thank you,
Sharon. Thank you,
Sharon.
Daphne.
Yeah, thank you, Naising and Sharon, for the excellent presentation and all the useful insights that you have shared. We have now come to the end of today's session. Thank you once again for joining us. You may stay connected with IBF via LinkedIn or via our website. Thank you all, and goodbye.